Mr. AG here, Asian guy bringing you the complete picture. Silver just crashed to below $65 per ounce. That is the lowest level in over a month and a half. In the last session alone, silver dropped 19.1%. For the week, we are down almost 16%. Last week, we dropped 18%. That was the biggest weekly fall since 2011. 2 consecutive weeks of double-digit losses. 1 month volatility has climbed above 110%. And yet, right in the middle of all this chaos, UBS just released a research report with price forecasts that I think every silver investor needs to see. They are projecting silver could hit $105 per ounce by March, $100 by June, $95 by September, and then cool off to $85 by December. That is a potential 47% gain from current levels to the March target. In the middle of the worst silver crash in over a decade, one of the world's largest banks is saying silver could nearly double from the lows. Let me break down exactly what they are seeing, why they think this happens, and what could go wrong. Before we go any further, let me be absolutely clear about something. I do not sell courses. I do not sell signals. I do not sell mentorships. I do not have any paid products of any kind. I share this analysis because so many of you have told me this content helps you understand what is really happening in markets, see both sides of every situation, cut through the mainstream noise, and make more informed decisions. That is why I do this. I present the data, I show you what the bulls are seeing and what the bears are seeing, and I let you decide. Now let me get into what UBS is actually forecasting because the numbers are significant. Drop a comment right now. Where are you watching from? What country? What city? I want to see how global this community has become, and while you are down there, tell me what you think of UBS's forecast. Do you think silver can really hit $105 by March? Or do you think more downside is coming first? I want to hear your honest take. Let me know in the comments. Now let me walk you through the current situation because understanding where we are helps you evaluate where we might be going. Spot silver is currently trading around $71.32 per ounce after a 19.1% drop in the last session. Earlier in the day, it fell as much as 10% to trade below the $65 level, touching a more than 1.5 month low. That is a significant technical breakdown. We crashed through multiple support levels in a single session. For the week, silver is down almost 16%. Last week, it dropped 18%, which was the biggest weekly fall since 2011. Let me put that in perspective. We have to go back 13 years to find a week as bad as last week for silver. And then this week was almost as bad. 2 consecutive weeks of carnage that have wiped out months of gains. The UBS research report describes what happened in stark terms. Silver tumbled 26% in a single trading session. Intraday pullbacks from recent highs neared 38%. These are moves rarely seen in decades, not years, decades. This is historic volatility by any measure. The report notes that this sharp repricing pushed historical volatility to extreme levels. 1 month volatility climbed above 110%. Let me help you understand what that means. Normal silver volatility might be in the 20 to 30% range. Bitcoin's volatility during recent turmoil was around 39%. Silver's 1 month volatility above 110% is nearly 3 times Bitcoin's level. The supposed safe haven metal was swinging more wildly than cryptocurrency. This extreme volatility prompted CME Group to raise margin requirements for silver futures. When margin requirements increase, leveraged traders must either post more collateral or reduce positions. Many cannot post additional collateral quickly enough. They are forced to sell. That forced selling pushes prices lower. Lower prices trigger more margin calls. More margin calls trigger more selling. It is a cascade effect that amplifies moves beyond what fundamentals would justify. Let me ask you something. What time is it where you are right now? Morning? Afternoon? Late night? Drop it in the comments. I'm curious when people around the world are consuming this analysis. Are you watching before Asian markets open? During European hours? After US markets close? Let me know. Now let me get into the UBS forecast because this is what makes this situation so interesting. Despite all the chaos, despite the worst weekly performance since 2011, despite volatility above 110%, UBS is projecting significant upside from current levels. Their forecasts for 2026 are as follows. March 2026, $105 per ounce. June 2026, $100 per ounce. September 2026, $95 per ounce. December 2026, $85 per ounce. Let me unpack what this forecast is actually saying. UBS sees a near-term rally that takes silver from current levels around $71 to $105 by March. That is a 48% gain in roughly 2 months. Then they see silver peaking around $100 in June before gradually cooling off through the rest of the year to end at $85. This is what they call a mid-year peak followed by normalization. Strong investment momentum and macro hedging demand fuel a near-term rally, but elevated volatility and weakening industrial consumption ultimately pull prices back as the year progresses. The rally overshoots fundamentals in the first half, then reality reasserts in the second half. Now let me explain the thesis behind this forecast, because understanding the reasoning helps you evaluate whether you agree with it. UBS links the current repricing to shifting macroeconomic narratives. Specifically, they point to easing tail risk concerns surrounding central bank independence following leadership changes at the Federal Reserve. The Warsh nomination changed expectations about Fed policy. Markets are recalibrating what that means for the dollar and for precious metals. But here's where it gets interesting. UBS projects that maintaining elevated silver prices would require investment demand to exceed 400 million ounces this year. 400 million ounces. Against an estimated market deficit of nearly 300 million ounces. Let me explain what those numbers mean. The silver market has been in a structural deficit. Demand exceeds supply by roughly 300 million ounces annually. That deficit alone should support higher prices over time. But for silver to reach and maintain the levels UBS is projecting, investment demand specifically needs to be exceptionally strong. Investors need to absorb not just the deficit, but additional supply. That requires sustained buying pressure from investors around the world. And here is the key factor UBS identifies. The participation of Asian investors, particularly in China, is viewed as the key determinant of near-term price direction. How Asian investors respond to the recent volatility could either stabilize the market or accelerate further swings. If Asian buying returns strongly after this crash, silver could rally toward those $100 plus targets. If Asian investors become cautious or take profits on existing positions, more downside could materialize. The report notes that Chinese silver was trading at a notable premium to US and London benchmarks before the crash. That premium indicated strong Asian demand. The question now is whether that demand returns after the volatility or whether Asian investors have been shaken out. A quick question for the community. Are any of you watching from Asia right now? China, India, Japan, Singapore? I am particularly curious what the sentiment is in Asian markets. Are people viewing this crash as a buying opportunity, or are they staying on the sidelines? Drop your location and your read on local sentiment in the comments. Now let me share what JP Morgan is saying because it provides useful context alongside the UBS forecast. JP Morgan said in a note that relatively rich silver valuations leave the metal vulnerable to outsized corrections in risk-off sessions. That is exactly what we have seen. When risk appetite diminishes, silver gets hit harder than gold because it has higher beta. It moves more in both directions. But here's the important part. JP Morgan sees a higher near-term floor around $75 to $80, and they see a recovery toward $90 next year. So JP Morgan's view is more conservative than UBS, but still constructive. They think the downside from here is limited to the $75 to $80 zone, and they see meaningful upside toward $90 as conditions stabilize. If we synthesize both bank views, we get a picture where the floor is, somewhere in the $75 to $80 range. The near-term potential is somewhere between $90 and $105, and the longer-term equilibrium is somewhere in the $85 to $95 range. Different banks, different specific numbers, but broadly similar directional views. Both are bullish from current levels. Both see meaningful upside. They just disagree on magnitude and timing. About 60% of you watching right now are not subscribed to this channel. If this analysis is helping you understand what major banks are seeing, if it is giving you perspectives you are not getting from mainstream media, consider hitting subscribe. I do not do hype. I do not do fear-mongering. I present the data from multiple sources and let you make your own decisions. If that approach resonates with you, subscribe. Now let me address the challenges that could prevent these bullish forecasts from materializing, because UBS is not blindly optimistic. They lay out the risks clearly. The first challenge is elevated volatility itself. UBS cautions that heightened uncertainty may trigger additional deleveraging among existing holders. Investors who survive the initial crash may decide they cannot stomach this level of volatility. They may sell even at lower prices just to escape the stress. This leaving the market vulnerable to further bouts of forced selling. More volatility could beget more selling, could beget more volatility. A negative feedback loop that pushes prices lower regardless of fundamentals. The second challenge is industrial demand. Industrial consumption accounts for more than half of global silver demand. Solar panels, electronics, medical devices, industrial applications are the majority of silver use. And UBS notes that sustained high prices are likely to encourage substitution, efficiency gains, and delayed purchasing by manufacturers. We already saw this with Pandora switching to platinum plating to avoid silver volatility. Other industrial users may be doing similar things. If prices stay elevated, manufacturers find ways to use less silver or substitute other materials. that gradually erodes consumption over time. The higher and longer prices stay elevated, the more industrial demand gets destroyed. The third challenge is positioning dynamics. UBS notes that traditional bullish drivers, such as exchange-traded fund inflows and speculative net-long futures positions, were already beginning to fade before the correction. The market was losing momentum even before the crash. Inflows were slowing. Positioning was becoming less supportive. The crash may have accelerated a trend that was already underway. The fourth challenge is the dollar. Ilya Spivak from Tasty Live explained the current dynamic clearly. Risk appetite does look diminished. Stocks are down. Bitcoin is coming apart at the seams. There's all kinds of evidence that risk sentiment in general is weakening. In this environment, gold is kind of holding its own and silver is caving in under the risk-off pressure. The US dollar steadied near a 2-week high and was poised for its strongest weekly performance since November. A stronger dollar makes dollar-priced assets more expensive for international buyers. That is a headwind for silver that could persist if risk-off sentiment continues. Let me ask you directly. Given everything I have shared so far, do you think silver hits $100 before it hits $60? Drop your prediction in the comments. I want to see what this community collectively believes. Now let me present the complete bearish case because you need to understand all the risks. The bearish case starts with the magnitude of the crash. Silver is down 34% from its January highs in just a few weeks. That is not a correction. That is a crash. And crashes often have follow-through. The first leg down is rarely the last leg down. There could be more pain ahead before any sustainable bottom forms. Volatility above 110% is not normal. It signals a market in distress. When volatility is this high, prices can move dramatically in either direction on any given day. Trying to pick a bottom in this environment is dangerous. You could buy at 71 and see 65 the next day. You could buy at 65 and see 55 the next day. The swings are unpredictable. The weekly performance data is sobering. Down 18% last week, down 16% this week. The biggest weekly losses since 2011. When you see back-to-back weeks this bad, it often signals something more than temporary volatility. It signals a change in regime, a change in trend. JP Morgan explicitly stated that relatively rich silver valuations leave the metal vulnerable to outsized corrections and risk-off sessions. That suggests more downside is possible if risk-off sentiment continues or intensifies. Global stocks are falling, crypto is crashing, risk appetite is diminishing, silver is vulnerable in this environment, industrial demand is at risk, Pandora is switching away from silver. Other manufacturers may follow. If industrial demand erodes, a major pillar of silver's fundamental support weakens. Asian investors are the wild card. If they step back from the market after this volatility, buying support disappears. UBS explicitly identifies Asian participation as the key determinant of near-term direction. That is a double-edged sword. If Asian buying does not return, prices could fall further. The 400 million ounce investment demand requirement is a high bar. Meeting that level of demand in an environment of extreme volatility and risk-off sentiment seems challenging. If investment demand falls short, prices cannot reach the elevated levels UBS is projecting. Rate cut expectations support silver, but cuts may not come as quickly as hoped. Markets expect 2 25 basis point cuts in 2026, with the first in June. If those cuts are delayed or fewer than expected, the interest rate tailwind for silver weakens. That is the bearish case. It is comprehensive and data-driven. Now let me present the complete bullish case because the bears are not telling the whole story. The bullish case starts with the fundamental deficit. The silver market has a roughly 300 million ounce annual supply deficit. Demand exceeds supply. That is structural. That is not going away because of price volatility. Mine supply takes years to develop. The deficit will persist regardless of short-term price swings. Deficits eventually get priced in. They support higher prices over time. UBS is projecting $105 by March. JP Morgan sees $90 as a recovery target. These are major institutions with significant research resources. They would not publish bullish targets if they did not have conviction. When major banks are bullish, that represents institutional money that could flow into the market. The crash was driven by mechanical factors, margin calls, forced liquidation, CME margin hikes, algorithmic selling cascading through thin liquidity. This is not fundamental selling. This is technical unwind of leveraged positions. When the technical selling exhausts, fundamentals reassert, and fundamentals point to higher prices. Silver has proven it can rebound sharply when bets become skewed. The same volatility that drove prices down can drive prices up. A fresh spike in geopolitical tensions, a dollar retreat, or a shift toward lower rate expectations could lure buyers back fast. Silver could rally just as violently as it fell. Chinese silver was trading at a premium to Western prices before the crash. That indicates strong underlying demand in Asia. That demand does not disappear. It may pause, it may wait for stability, but it is there. When Asian buyers return, they provide significant support. Rate cuts are coming. Markets expect at least 225 basis point cuts in 2026, with the first in June. Non-yielding assets like silver tend to do well in low interest rate environments. As cuts approach and materialize, silver should benefit. Gold is holding its own in the current risk-off environment. Gold rose 0.4% to $4,790.80 per ounce, even as silver crashed. Gold's resilience suggests the precious metals thesis is not broken. Silver tends to follow gold's direction over the medium term. If gold stabilizes and recovers, silver should follow with higher beta. The extreme volatility is creating buying opportunities for patient investors. Silver at $71 is 34% cheaper than it was a few weeks ago. The same metal, the same fundamentals, just a lower price. For long-term investors who believe in the thesis, this is exactly when you want to be accumulating. Not when everyone is bullish at the highs, but when everyone is panicking at the lows. The UBS forecast of a mid-year peak followed by normalization makes logical sense. Investment momentum drives prices higher than fundamentals justify. Then reality catches up and prices moderate. But the normalization level of $85 is still higher than current prices. Even the bearish scenario is bullish from here. Let me share something interesting about how you can interpret these forecasts. UBS projects March at 105, June at 100, September at 95, December at 85. That is a trajectory that peaks and then declines. But notice that even the December low of $85 is still 20% above current prices around $71. The bears scenario is still bullish relative to today. JP Morgan sees a floor around 75 to 80 and recovery toward 90. Again, even their conservative view implies upside from current levels. When both the bullish and bearish bank scenarios imply higher prices, that tells you something about where the balance of probabilities lies. What country are you watching from right now? Drop it in the comments. I want to get a sense of where this community is geographically. And tell me if you are planning to buy silver at these levels or waiting for more clarity. Now let me talk about what I am watching over the coming weeks, because several factors will determine which scenario plays out. Watch the $75 level. JP Morgan identifies this as the potential floor. If silver holds above 75 and builds a base, that is constructive for recovery. If silver breaks decisively below 75, more downside could materialize. Watch the $65 level. Silver touched below 65 earlier this week before bouncing. That level has now been tested. If it gets tested again and fails to hold, that would be a bearish development. Watch Asian market action. UBS explicitly identifies Asian investor participation as the key determinant. If we see buying emerge from Shanghai, if premiums rebuild, if Chinese demand returns, that is bullish. If Asian markets remain weak and selling continues, that is bearish. Watch the dollar index. Dollar strength is a headwind. Dollar weakness is a tailwind. The direction of the dollar over the coming weeks will significantly impact silver's trajectory. Watch for rate cut signals. Any Fed commentary that shifts expectations about the timing or magnitude of cuts will impact precious metals. Dovish signals support silver. Hawkish signals pressure silver. Watch gold's action. Silver tends to follow gold with higher beta. If gold stabilizes and begins recovering, silver should follow. If gold breaks down further, silver will likely fall harder. Watch volatility measures. 110% volatility is extreme. For the market to stabilize, volatility needs to come down. If volatility remains elevated, expect continued wild swings. If volatility begins moderating, that suggests the market is finding equilibrium. 3 key takeaways and then we are done. Number 1, UBS forecasts silver at $105 by March, $100 by June, $95 by September, and $85 by December. This represents a mid-year peak followed by normalization, as powerful investment momentum gives way to fundamental constraints. Their thesis requires investment demand to exceed 400 million ounces against a market deficit of 300 million ounces. Asian investor participation, particularly from China, is identified as the key determinant of near-term direction. JP Morgan has a more conservative view with a floor around 75 to 80 and recovery target around 90. Both banks are bullish from current levels, despite diverging on specific targets. Number 2, the current crash is historic by multiple measures. 19.1% single-day decline. Back-to-back weekly losses of 18% and 16%, the worst since 2011. One-month volatility above 110%, nearly 3 times Bitcoin's volatility. Silver touched below $65, a 1.5-month low. CME margin hikes have amplified forced selling. This is mechanical unwind of leveraged positions rather than fundamental reevaluation. When technical selling exhausts, fundamentals can reassert. Number 3, significant challenges could prevent bullish forecasts from materializing. Elevated volatility may trigger additional deleveraging. Industrial demand faces pressure from substitution and efficiency gains at high prices. Risk-off sentiment and dollar strength are headwinds. Asian investors are the swing factor, and their response to volatility will determine direction. However, even the bearish scenario from UBS at $85 by December represents upside from current levels around $71. Both bank forecasts imply higher prices ahead despite near-term risks. Let me leave you with this thought. The market is giving you two completely different signals simultaneously. The price action is screaming danger. 34% crashes. Worst weeks since 2011. Volatility above 110%. Everything about the short-term technicals says stay away. But the fundamental analysis from major banks is screaming opportunity. 300 million ounce supply deficits. Forecasts of $100 plus by mid-year. Even the conservative targets imply significant upside. How you reconcile these conflicting signals depends on your time horizon. If you're trading daily or weekly charts, the volatility is too extreme to navigate safely. Position sizing has to be tiny, stops have to be wide, or you stay on the sidelines entirely. The short term is genuinely dangerous. If you're investing on monthly or yearly timeframes, the crash is potentially opportunity. Lower prices on the same fundamental thesis, the same supply deficits, the same industrial demand drivers, the same central bank buying of gold, just cheaper entry points. For patient capital with no leverage, this is exactly what you hope for. Know which category you're in. Position accordingly. Do not trade a yearly thesis on a daily chart. Do not hold a daily trade with a yearly time horizon. Match your positioning to your actual strategy. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Have a clear plan and know your time frame. The volatility is extreme. The opportunity is real. But so is the danger. Only you can decide which matters more for your situation. Drop your thoughts in the comments. Where are you watching from? What do you think of the UBS forecast? Are you buying at these levels or waiting? I read every comment and they help shape what topics I cover next. The market will tell us over the coming weeks which scenario unfolds. Watch the levels I mentioned. Watch the factors I identified. Let the data guide you rather than emotion. Stay sharp, stay informed, and make decisions based on logic, not panic. This is Mr. AG, Asian guy bringing you the complete picture. I will see you in the next one.